So we're down into a 1 minute chart here, everything being equal. And that balanced price range, you can see the range between 10 a.m. and 11 o'clock, New York local time, always. I want you to take a look at that little area right here on TradingView. At the time of watching real-time price data, generally you're going to have electronic trading hours highlighted, and it would look like this in your TradingView. If you have live data and you paid for that live feed from TradingView, you can toggle from electronic trading hours to regular trading hours and see more detail. So if you click on that, it's going to change it to an option of regular trading hours or electronic trading hours. If you toggle it to regular trading hours, your chart would show this. Okay, and this is what I teach, is the opening range gap. Okay, now I taught this to charter members, I taught this to old ICT mentorship students, and this is not something that has been just introduced because other people have talked about it recently. I've been doing this since 1996. So these are things that, they have been there in the marketplace all this time. And while I don't claim the real estate here, as a creator of this, it's just, this is one gap I like to see used. Now, if you take this gap, and I'll explain what I mean by that, the closing price, the previous session, and where we open at 9:30, that is the opening range. If there's a gap and we gap higher and we're bullish, this is how you use the information. You expect price to trade down to it, reprice to the gap, and then go higher. Move away from the direction of the gap after it fills. If we are bearish and we see a gap like this, then it could become a trade lower, fill the gap, consolidate, false run, and then break lower. Or if we're in consolidation and we have already met some higher time frame weekly objective and we have a gap higher like that, then what can happen is once the gap fills, nothing happens. It just uses this entire gap throughout the day. But because we've been bullish, as I highlighted yesterday, it's a gap higher, opening, fills, and reprices down into that opening range gap low, which is where the session closes on regular trading hours the previous day. You can always find that price by simply just toggling the electronic trading hours to regular trading hours. This is why the RTH is down here. You'll see that separation here. So what's hiding is all the electronic trading from where it traded yesterday at settlement to where we opened at 9:30 opening bell in New York local time in New York. So that difference there is going to be sometimes shown as a gap. It could be a gap higher like we see here, or a gap lower, or it could be unchanged. We would like to see a gap of some kind because a gap always creates an inefficiency, and inefficiencies are many times, not always, many times repriced too. And how we use that information is paramount going forward. What I teach, this is something that's unique to me, this gap, once it's completely repriced, then if we're bullish, we can take that gap and do multiplications of that and project it higher. So if you take that range from the low to the high and you multiply it up, you can get 2 standard deviations, which essentially gets us real close to the high without even needing that premium fair value gap that's in the pink area. Okay. So in terms of my Power 3, the daily range was shown at the opening at 9:30. It trades down, which is a Judas swing. Traders that are retail traders, they'll chase that move going lower because they're not aware of that inefficiency between regular trading hours and how the electronic trading hours are hidden when you look at a chart like this. There was trading, but now we're met with an opening range at 9:30. So that opening bell, which is all the volatility that initially comes in the marketplace, is usually this type of function where it seeks to reprice to the previous session's close. So we see that here, it drops down, creates the low of the day, and then starts to trade higher. As soon as we meaningfully move above the opening price here on this type of day, which would be really essentially swinging above this, then the market does what? It really starts to run higher for a premium. What premium? The premium fair value gap that's shaded in pink. Watch the beginning of the video. I take your attention from higher time frame down, so that way you can keep track of what I'm looking at and how it's salient. So essentially what we're looking at here is my Power 3 concepts, which is the open, manipulation, accumulation of longs, distribution into a premium, and then settle at the day, close. So power 3 is being shown here. The daily range is a classic ICT buy day. The Judas swing to reprice the opening range gap low, which is down here. Also a daily fair value gap consequent encroachment confluence. That means that the midpoint of that daily discount fair value gap, which is here, it trades down into that. Additional credit, if you want to go into your new day opening gap, and I did a video presentation about that on this YouTube channel just a few videos back. Go watch that, and you'll see how you can use the new day opening gap also as a confluence of this low as well. So many factors of why it went down here. A trader that uses retail logic would not be able to see all these confluences that I'm showing you here. And then a draw to buy side liquidity that was shown in Twitter on May 16th, which was yesterday of 2023. And then the high of the day was booked at the daily premium fair value gap high. And when you have all those details over here, there's your high, there's your low, all these details coming in together, making a beautiful tapestry of how the algorithm itself prices, reprices, redelivers, balances, and then seeks new liquidity. That is essentially what you're doing when you're trading with my concepts. You're seeking what the algorithm's likely to do, move higher or lower. Why should it go higher? For an inefficiency, or to take out buy stops. If it's trying to move lower, why is it going down lower? It's going down to trade to an inefficiency or take out sell stops. If it's not going to do either one of those, it's going to consolidate and range bound and frustrate traders, which is what we've been basically seeing for a number of days now, and weeks really, if you want to be dogmatic about it. So there's a lot of detail in a back testing procedure. Okay, and you go through and you use all these little areas over here and you fill in your observations. And you want to kind of like cheerlead yourself and talk about look how the market respected this silver bullet, which is a fair value gap on the 3-minute chart, but we're watching a 1-minute chart now. So all those things that was annotated on the 3-minute chart was transposed to this 1-minute chart. You want to include everything that you see and observe. Everything. And that way you'll have more detail in your journal instead of just showing some charts and maybe a scribble here and a scribble there of useless information. You really want to make this kind of like a meditation. And yes, it takes a lot of time. Yes, it takes a lot of work and effort to be organized, to have your charts mean something to you. What you're doing is you're writing the most important, useful trading manual that you'll ever read. And you're doing it with your own eyes, your own experience, your own annotations, your own charting, your own snapshots of each individual chart and each individual respective time frame. There's no better trading book or journal or instructional manual on price action than what you're going to be creating by doing this. And that's why it takes time.